Now let's look at the budget itself. Nigel and I spent pretty much the Tuesday evening to have a look at it. From our point of view, it's pretty interesting. It's sort of a mixed bag. It's sort of a lot of goodies and a lot of baddies as well, if you like, if I could term it that way. And it'll be interesting to see how this rolls through the Parliament and through the Senate as well. Could this perhaps potentially an interesting budget that perhaps could trigger an early election is something we will have to wait and see. Now let's move and check the session overview. Right. Now I've got it on the screen here. As I said, there were quite numerous areas and issues that were being considered on Tuesday night. So what I've done to make it simple is just to, I guess, sort of summarize in different sections and the issues which concerns tax in general, which I'll go through. There's one particular interesting one on car fringe benefits, and I want to take you through what the changes are, and certainly looking at perhaps what consideration options that we have, and certainly the opportunities that we should be thinking for our clients. A few changes in the CGT area, capital gains tax, so I'll provide a summary there. And the last couple of areas that we will look at will be superannuation changes, and finally Social Security, some of the welfare changes there. So first one that I'd like to take you through will be looking at HECS, the Higher Education Contribution Scheme. As you would know, if you have clients where they have kids at uni, then potentially there's an amount which could arise as a result of the uni fees, HECS. And at the current time, there is obviously an option for the parents to pay upfront, which you then would get a 20% discount. For example, if the fee cost is $10,000, then certainly $2,000 would be discount if you pay upfront. And in addition to that, you could have if you're not paying the full amount of $10,000, and if you pay $500 more at a particular point in time, you could get a 10% discount. So what the change means is that from 1st of January 2012, if you're making upfront payments, the discount which you would have normally have got at 20% would now be reduced down to 10%. And for any payments which are $500 or more, instead of 10%, it will be down to 5%. So what does that all mean for your clients? I guess 20% would have been certainly better than 10. And one would consider if, I guess for this particular year, before 1st of January 2012, then I guess the last chance to have the higher upfront discount. So if one could pay earlier by that date, then taking 20% would be quite worthwhile. But having said that, let's consider if pretty much would you then stop paying the upfront payment if the discount drops to 10. I guess it depends on each individual situation. 10% is still a reasonable discount. But on the other hand, if we look at how HECS actually works, is you would accumulate the loans, and if you accumulate loans, then it's not becoming payable until such time as when one goes out to the workplace and start earning $47,000 or above for this current 2011-12. So that means that it might be possible that the HECS may never be paid. These days we have students and kids that go through uni and keep on in education or keep on going overseas, and therefore that amount may never be payable. So as much as we may get a discount, on the other hand, if we don't pay it, then that would accrue as a liability anyway. Perhaps in the case it may not ever be payable. So one needs to consider, should we pay the upfront for 10%, or perhaps we just leave it, and perhaps there may be a case that you might just leave it and remain unpayable for a long time anyway. So I'll leave you with that one there. Certainly the discount is going to be a bit lower than before. Now this is another interesting change. For years we've been obviously pushing the fact that if you have a family trust set up, a distribution from a family trust, and through the low income tax offset, if we make a distribution of unearned income to minors, and because of the low income tax offset that we have, that allows us to distribute $3,333 based on the low income tax offset of $1,500 to minors without paying the penalty tax. Unfortunately, that's going to be taken away, and in fact, that would happen obviously provided the bills come through. Remember, all these changes are still subject to, there are proposals. They will need to go in the bill form and to go through the various houses before they come into effect. So if I could make assumption that this will come through, then from 1st of July 2011, we no longer have that offset, which means, and all of you will be familiar with that number, $416, that before the penalty tax applies on distribution of unearned income to minors. So that means from 1st of July 2011 onwards, without the LITO of $1,500, then all we do have is a distribution of $416 before it is certainly not worthwhile then to distribute to minors, kids under 18 years of age. Remember, this only applies to unearned income. Therefore, if earned income, if the minors are working in their own right, we still have the normal $6,000 tax-free threshold and the adult tax rate. It also doesn't apply to child pension and testamentary trust distribution. So bear that in mind. Lifetime trust is one which family trust which provides the unearned income, but certainly if it's coming from a testamentary trust, then we would have the normal tax-free thresholds and the adult tax rate. So what this does is to catch distributions from family trusts, which makes, therefore, from 1st of July this financial year coming, that the distribution and income split is no longer as effective as it used to be. So I guess for the next, where are we now? We're in May. So by next month, then certainly this will be the last financial year that we could still certainly have the benefit of the low income tax offset and have the full $3,333 distributed effectively, but from 1st of July, therefore, that wouldn't be the case. So I guess all in all, as advisors, we should be certainly looking even more so at testamentary trusts and more into our estate planning. Wouldn't be good if we do inherit a testamentary trust. Unfortunately, as you know, death is a problem, and certainly death is one where you need before testamentary trust could be set up. But having said that, if that was the right situation, testamentary trust could be passed on, and remember, testamentary trust could be passed on for a number of generations as well too. So that's the change for low income tax offset for the coming year. Now, we've had quite a year already, and as you know, we had the flooding, we had the cyclones as well. So certainly a lot of resources need to be obviously sought after for the reconstruction, and as a result, the government is imposing a one-off temporary levy to apply for the next financial year. It works very, very simply. We've had sort of levies in the past before. A good example would be East Timor levy, a one-off, and similarly with this as well too. And the way it would work is that for an individual with taxable income $50,000 or less, there's no levy. But if you earn, or if your clients earn between 50 and 100,000, there will be an additional 0.5% of any amount above 50,000. So it works like a Medicare levy. So therefore, someone earning between 50 and 100,000, then there'll be an extra 0.5% on any amounts in that range. So 1.5% Medicare levy would obviously apply to the whole lot, but certainly the 0.5% will apply to amounts between 50 and 100, and for those earning over 100,000, then you would then pay 0.5% on the 50 to 100, and then a 1% on any excess over 100,000. I do have a question here. The first question: are recipients of a flood crisis payments exempt? There are certainly some categories of exemption. Yes, some recipients could be exempt from there. So So we will need to look at what categories are exempt. So there will be some exempt categories which we need to watch out for. So in terms of the considerations and impacts, I was saying earlier on, therefore, for someone earning up to $100,000, $250 levy, and someone 200,000 would obviously have the extra 1,000 plus 250, so 1,250 will be someone at 200,000, and obviously beyond that there'll be additional 1% on anything in excess of 200,000. Now, I guess if we're trying to work around it, then it's all about taxable income. Remember, this is based on taxable income. It's not ATI. It's not adjusted taxable income. So this is, in a way, a bit simpler to strategize around. So if we could have deductions, if we have salary sacrifice, super contributions, and possibly deferring. Remember, this is a one-year, one-off levy. So if you were to defer income into the following year, or getting the expenses from this year into next year, certainly that would help with the reducing of the levy, simply because you're reducing the taxable income. So I'll leave you with this to consider for your client. The flood and cyclone reconstruction levy, I guess, it's all our responsibilities in one way or another to allow for and pay a levy to get reconstruction underway.